Welcome to the Deep Dive. This is where we take stacks of information, reports, articles, our own notes, and really boil it down to the essential insights for you. Today we're diving into the latest financial results from Kalyan Jewellers India Ltd. We're looking at Q1 for the financial year 26. We've got their investor presentations, the unaudited financials, press releases, plus some questions we've been mulling over. Our goal: to unpack all this, find the interesting bits, and help you understand what it means for Kalyan,
but also for the wider Indian jewelry market. Basically get you up to speed fast. So let's kick things off. Kalyan Jewellers, for anyone maybe less familiar, what's the story here? How did they get so big?
Yeah, they started in textiles back in 1908 in Thrissur, Kerala. So there's this really deep legacy there built around, trust and transparency. They're actually pioneers in things like BIS hallmarking for gold, even before the government made it mandatory, and using parameters and stores so customers could see the purity for themselves.
That kind of trust building is huge in jewelry, right?
Yeah.
So how does that translate into their current footprint?
It's massive. They have a really significant presence across India, plus operations in the Middle East
and the USA. They did their IPO in 2021, and as of the June 30th, 2025, they're running 406 showrooms globally.
Okay, 7,268 crore. How does that compare?
That's up 31% compared to the same quarter last year, which was 5,528 crore, so solid growth there. And then profit after tax, PAT, on a consolidated basis, that came in at 264 crore.
Compared to?
178 crore in the previous year, so that's a 49% jump in profit. Pretty significant.
Almost 50% profit growth. Wow. That's the overall picture. What about just India? How does the core domestic business do?
India on its own was also very strong. Standalone revenue for India
Was 6,142 crore, also up 31% year on year.
Same growth rate as consolidated. Interesting.
Exactly, and the standalone PAT, the profit just from India, that grew.
also strong, 32% year-on-year growth. You break it down, the Middle East, which is their main international market, did 1,026 crore in revenue. That's up 27%. And the profit from the Middle East was 22 crore, up 18%. So yeah, healthy growth overseas too.
Got it. And they also have that online piece, Canvas Chat. How did that perform in the quarter?
Yeah, their lifestyle jewelry platform recorded revenue of 66 crore.
Okay, and profitability?
It actually posted a net loss
Of 10 crore for the quarter.
Okay. So still investing in growth there, perhaps?
Seems likely, yeah. Often happens with these digital platforms in the scaling phase, investment in tech, marketing.
Yeah, that's crucial. Same-store sales growth, or SSG, was a big driver. That measures growth in stores open for at least a year, so it shows underlying health.
And the numbers were?
Pretty robust. 20% SSSG in South India and 16% in non-South India.
Wow, 20% in the South. That's very strong.
It really is. Shows strong organic demand, not just growth from opening new shops.
What about getting new people through the door? New customers?
That also looked healthy. They said new customers made up over
38% of their customer base during the quarter.
Over a third. So they're consistently attracting fresh buyers.
Exactly. It shows their marketing and outreach are working, expanding the base.
Do we...
Precisely. That's a big deal for them. Shows their pan-India strategy is really paying off. In terms of products, studded jewelry, diamonds, gemstones held steady at about 30.3% share in India. But interestingly, in the Middle East, the studded share increased, went up to 18.4% from 16.4% last year. So maybe a growing taste for diamonds there.
Interesting regional difference. Now, the press release mentioned things like operating leverage and procurement gains helping margins.
Can we simplify that a bit? What does that mean practically?
Sure. Operating leverage basically means as their sales go up, their fixed costs like rent, core admin staff don't rise as fast.
Okay, so better efficiency, better buying. But they also mentioned margins were slightly lower overall because of franchises.
Right. So the overall gross margin and EBITDA margin were slightly lower. EBITDA is earnings before interest, taxes, depreciation, and amortization, a good measure of operational profit.
Why lower?
Mainly because a higher chunk of revenue, about 43% in India this quarter, came from their franchise showrooms, the FOCO model. But, and this is key, that slight dip was offset by those operating efficiencies
And procurement gains we just talked about. And importantly, the PBT margin profit before tax actually expanded, and that was driven by the increasing share of these FOCO showrooms.
Ah, okay. So the French...
four FOCO Kalyan stores in the Middle East.
So quite a few already. How does it work?
Well, the clever part is, in the FOCO model, the franchisee puts up the money for the inventory. They own the stock. And the franchisee also covers most of the showroom running costs like rent, utilities, everything except the staff salaries, which Kalyan still handles.
Ah, I see. So Kalyan doesn't have to tie up its own capital and inventory or store fit outs for these locations.
Exactly. It dramatically reduces their capital expenditure for expansion, makes it much lighter on their balance sheet. This significantly boosts their capital efficiency, their return on capital employed,
or ROCE. It lets them expand faster with less financial burden. It's a pretty smart strategy.
Definitely sounds capital efficient. Now, they also have this huge My Kalyan network.
Focused on urban, semi-urban, and rural areas. They really push the neighborhood jeweler idea. And it works. It contributed about 16% to their India revenue this quarter, and around 31% of enrollments in their purchase advance schemes came through My Kalyan.
So it's a major customer acquisition and sales channel, especially outside the big cities.
Absolutely. It's key to their deep reach.
And are they using tech to support all this? The showrooms, My Kalyan, everything?
Oh, definitely. They're leaning quite heavily into analytics for customer outreach,
trying to make marketing more targeted and effective. Candor, their online platform, obviously gives them digital reach in India, the US, and the UK. Even the My Kalyan staff
the backdrop is pretty positive for organized players. India is the world's second biggest gold market, huge wedding demand making up maybe 60%. Crucially, there's this ongoing shift from small, unorganized jewelers to larger, organized chains like Kalyan.
That formalization trend we hear about.
Exactly. Organized retail share is projected to hit maybe 40% by 2025, up from around 32% just a few years ago. And things like mandatory hallmarking, which came in 2021, really push customers
towards trusted, compliant players. It builds confidence.
And that plays right into Kalyan's established trust factor.
Absolutely. Plus, don't forget rural India, it still accounts for something like 60%.
positive about the upcoming festive season.
Okay. And strategically.
Key priorities seem to be maintain steady same-store sales growth, mid to high single digits. Keep pushing ROCE higher, mainly through that capital-light FOGO model. Their ROCE was around 22% for the last 12 months, which is quite healthy. They also talked about shareholder value dividends, using 40-50% of profits for maybe debt reduction, new projects, and rewarding shareholders.
And expansion plans. Still focused on non-South.
Yes, definitely aiming to
Increase the revenue share from non-South markets. New showrooms will predominantly be open there, mostly using the FOCO model. They're also looking at ways to improve margins further, like
Fascinating. Okay, well, that really wraps up our deep dive into Kalyan Jewellers' Q1 results. A picture of really solid growth, some more strategic moves like the FOCO model, and leveraging that century-old foundation of trust.
It definitely paints a picture of a company adapting and thriving, which, leaves us with something interesting for you, the listener, to think about. As we see these traditional industries facing modern pressures, how vital is it to blend the new, capital-light models, digital tech with the old, those enduring
values like deep-seated trust and really localized neighborhood service? Is that blend the real key to sustain growth and staying relevant in today's market?